What's up, Financial Zen Masters? Today I'm going to answer for you one of the top three most common questions we get, which is, should I contribute to my Roth 401k or my traditional 401k? Let's find out. But first, welcome to the Financial Zen channel, where the big question is, how can you, a super successful, hardworking overachiever with kids at home and a mortgage to pay, how can you quit your 9-to-5 grind to go pursue your passion while still providing for your family? That's the question. I got your answers. I'm Rick Valenzi. I am a certified financial planner, the founder of Financial Zen, and your guide. So this is definitely in the top three questions that we get most common, and it's also the most common mistakes that we see when we first start working with people. So 75% of companies in the US offer a Roth 401k option now. So you have a Roth 401k and you have a traditional 401k. Now the mistake that we see people make is where they're putting their contributions, how much they're putting into each one. Typically what we'll see, if people aren't sure, they'll either do 50-50, so like, I don't know, both sound good, we'll do 50 in Roth, 50 in traditional, and they'll straddle the fence. Or we'll also see people that have heard about Roths, read up on Roths. Roths sound really good on paper, where sure, you get taxed now, but it grows tax-free and it comes out tax-free. That's gotta be good, right? So they pile into the Roth. Neither one of those are tied in with the right decision. The right decision is actually really, really simple. And that's simply it, and what that answer is simply, is your tax bracket going to be more now or in retirement? That's it. That's as simple as it gets. And the answer for most of the people that we work with, certainly all our Financial Zen members, is your tax bracket will be lower in retirement. And if it's lower in retirement, then we don't want to pay taxes on it now. We want to pay taxes on that money in retirement. So let's do a quick breakdown of how traditional 401ks and Roth 401ks work. So a Roth 401k is easiest to understand. A Roth 401k you put in after-tax money, meaning, just think about it like it doesn't go in there automatically. You get paid out, and instead of your company depositing directly in your 401k, you write a check to yourself from your checking account. After you get paid, you put it in the Roth, right? That's money that you will pay taxes on. You put it in your Roth, and then it grows tax-free. Never pay taxes again. Sounds pretty awesome, right? It grows tax-free, no capital gains tax. When you take it out, it's tax-free within certain limitations, but it's tax-free. And it's great. Sounds awesome. Fantastic on paper. With a traditional 401k, okay, that comes out before it hits your checking account. It becomes before you hit your taxes. So you don't pay any taxes on it today. It grows tax-free, but then when you take it out in retirement, you pay all the taxes on it then, after it's grown. Now, I've broken down the math in other videos and other blogs, so I'm not going to kill you with the math here, but that's the difference between a Roth 401k and a traditional 401k. So the answer is, so with a traditional 401k, you pay taxes later. With a Roth 401k, you pay taxes now. Now, let's break down what your income is now versus later. So our average per person income for the Financial Zen members is about $200K per year. That means a family of two working spouses making $400K per year. I promise I'm not going to kill you with math. Let's take out what they're saving. So they're maxing out their 401ks because they're Financial Zen masters and they know they should be. They are also maxing out their HSA, which I talked about yesterday. So that's $7,200 right off the top there. So that's 39 plus 7,200, $46,000, give or take, coming out. So now they're left, let's just make it simple math. So now they're left with $350, and that's what they're going to pay taxes on. If you're earning $350,000 in income, your tax bracket is going to be like 30%. So you take out the taxes, net of taxes, and you're left with about $250,000. Let's assume that you're also smart and you're maxing out your SPP and getting the free money, the free discount that your company gives you, so you're saving all that. So that's another $50K off the top. So now you're down to, what do we have? About $200K or so. So now you're living off of $200K, right? So the only thing we care about in retirement is what you need to live off of. Once you're retired, you don't need to be saving, right? You don't need to be saving anything. So pre-tax, after-tax, it doesn't matter. So what you need to generate in retirement is $200,000, and that's the exact same lifestyle that you're living right now. Does that make sense? So you can see where the math comes in. So today, your income is 350 grand. Your total household income is 350 grand. Okay, so you're going to pay taxes on that, and your tax bracket will be in accordance with that. In retirement, you only need 200K in living expenses, and so your tax bracket will be the 200K mark, which is about 26% all in if you live in California. Right? Do you see how that works? So it requires a shift in your mindset where when you're retired, you are generating the income that you report, right, that you pay taxes on, is just the income that you need to live your lifestyle. Now, the magic of retirement is we have, with our system, and it is possible, but with our financial Zen retirement distribution strategy, you can then have a choice between taking money out and generating that 200 grand that you need from either retirement accounts or from just taxable savings that you saved over the years. So that 50 grand that you're putting into the ESPP each year, right, that's going to build up over time. And then the magic is once you're retired, you have much more control over where your income is coming from. And by income, I just mean your living expenses is coming from. So that 200,000 that you might need in retirement to support your current lifestyle, let's say you can get 100,000 of that from your retirement accounts and the other 100,000 from your taxable accounts. So that now brings your taxable income down to $100,000, right? So that's just some of the levers that you have to pull once you are retired, and once you are able to manipulate your taxes much more so than you can right now while you're saving, while you're an employee. You don't really have that many levers to pull right now. You can max out your 401k, max out your HSA, sometimes a couple other things depending on your situation, but for the most part, that's it. Your income is your income. When you retire, because you're generating income just to support your lifestyle, right, and what you need in your living expenses on a monthly basis, that can come from wherever. Taxable, non-taxable, and you have more levers to pull, more ability to manage where your money's coming from and how much taxes you're paying. So there you go, Roth versus 401k, easy breakdown. You are most likely going to be paying more taxes now than you will in retirement because of your savings and because of your lifestyle and because of all the extra taxes that you're taking out now, whereas retirement where you only need your living expenses. So there you go. If you're a Financial Zen member, you likely 100% want to be saving in your traditional 401k, not your Roth 401k, because that'll help you taxes later. All right. Hope that was helpful. I know there's a lot of numbers in that one. Maybe watch it in slow motion and take some notes. But hope that was helpful. If you learned something, please subscribe and like the video. Leave a comment. Let me know, what you think your tax bracket is going to be now versus retirement. That might be fun. And we'll see you tomorrow.